How liquid are exchange-traded funds, ETFs, for investors? Imagine being able to buy or sell a large chunk of your investment quickly and without much fuss. That's what liquidity in exchange-traded funds is all about. These investment vehicles are designed to be traded on stock exchanges just like individual stocks, which means you can usually get in or out fast. But it's not just about how many shares are traded each day. ETF liquidity has two main parts. First, there is the secondary market liquidity. This is the trading activity you see during the day on the exchange. If an ETF has a high daily trading volume, it means you can buy or sell large amounts without moving the price much. The bid-ask spread, which is the difference between what buyers are willing to pay and what sellers want, tends to be smaller for more liquid ETFs. Second, there is primary market liquidity. This involves the creation and redemption process. Special authorized participants or market makers can create new ETF shares by delivering a basket of the underlying securities to the ETF issuer. They can also redeem shares by returning them in exchange for those securities. This process helps keep the ETF's market price close to its net asset value, which is the total value of the underlying assets divided by the number of shares. The liquidity of an ETF also depends heavily on the liquidity of its underlying securities. If the ETF holds large cap stocks or widely traded bonds, it's easier for market makers to create or redeem shares. That boosts the overall liquidity. But if the ETF invests in less liquid assets, like small stocks or niche bonds, it can be harder to manage supply and demand. This can make trading less smooth. For investors, this means that ETFs with highly liquid underlying assets tend to be more liquid overall. You can buy or sell large amounts quickly, with minimal price impact. Options on ETFs also benefit from this setup because the underlying ETF's liquidity supports options trading. Large trades can be executed without causing big price swings, thanks to the ability of market makers to create or redeem shares as needed. So, in simple terms, ETFs are generally very liquid investment options. Their unique structure combines on-exchange trading with the flexibility of creation and redemption, making it easier for investors to enter and exit positions efficiently. Whether you are trading stocks or options, this liquidity helps you manage your investments smoothly and confidently.